Worldwide equity markets since 1980. Since 2008, all major emerging markets have moved lower in price. The major emerging markets include Brazil, Mexico, Russia, India, and China. The broad emerging market index is down 25% over this time period. Russia and Brazil are at the bottom of the heap, while Mexico is at the top. For this same time period, the vast majority of developed or advanced countries have also moved lower. The one exception is the United States, S&P 500 index with its exceptional price performance. Of the majors, Italy is the worst performer. When the US is compared to broad advanced economies and emerging indexes, the US has outperformed these two indexes by a wide margin. While the S&P 500 is up 54% since 2008, the advanced economies, excluding the US, EFA, and emerging economies, EEM, are both down by 25% during this same time period. Commodities, destruction of commodity exporters. The broad categories of commodities has slumped significantly. Agricultural foodstuff, materials resource sector, and the energy sector are all down substantially since 2008. The Commodity Tracking Index, DBC, which includes all commodity groups, is down 55%. Energy sector. Summer gas prices haven't been this cheap since 2004, and there are growing signs they could slip even lower. America has record high gas inventories. In July, the US had 241 million barrels in storage. The gas glut shows no sign of abating. Oil producers worry that this glut means less oil will be needed, which, in turn, will worsen the oil glut. Finally, the coal sector is being wiped out, unless it is saved by clean coal technology. Agricultural sector. The annual average prices of all basic foodstuffs except dairy products have declined steadily from peaks reached in the mid-1990s to levels not seen for nearly 2 decades. More dramatic has been the decline in prices for tropical products. Coffee and cocoa prices had fallen by 2000 to their lowest levels for more than 30 years, although tea prices had held up until 2001. Among raw materials, cotton prices are at their lowest level since 1985. Materials resource sector. Materials have suffered as industry, the biggest user of materials, has slowed worldwide. China, which became the world's industrial leader, has shown much slower growth in recent years. Reasons for declines in commodity prices. Problems in the commodity sectors go far beyond liberal trade policies. These sectors are being impacted by market fundamentals of the worst kind. Emerging markets that depend on commodity exports are in a terrible situation. The people of Venezuela, a leading oil producer, are starving and rioting. The US government has always viewed commodities, like oil, as being volatile, and therefore, don't pay much attention to prices. Clearly, though, the problem lies with price levels. So this attitude is very harmful to countries around the world. Further, since all basic commodities are falling together, there is a big systematic problem here that's not being addressed. So the question needs to be asked, should we be concerned? Unfortunately, no reasons are given, and no ideas put forward. In past situations like this, governments have sought to control supply and prop up prices. However, these actions do not appear advisable given current worldwide economic conditions. Controlling supply through free rider programs, paying people not to grow foodstuff, will actually worsen the income distribution problem. These problems are worsened even more with farm incomes falling. Currency wars, aka, beggar thy neighbor policy. Currency war, also known as competitive devaluations, is a condition in international affairs where countries seek to gain a trade advantage over other countries by causing the exchange rate of their currency to fall in relation to other currencies. In October 2008, the Federal Reserve coordinated simultaneous interest rate cuts with 5 other major central banks. It also established currency swap arrangements, in which the Fed provided dollars in exchange for foreign currencies, with 14 foreign central banks, including 4 from emerging markets. However, once the crisis had passed and recovery begun, national economic interests began to diverge. In particular, some foreign policy makers argued that the Fed's aggressive monetary policies, undertaken to support the U.S. economic recovery, were damaging their own economies. 2 criticisms were prominent. First, raised prominently by Brazil's finance minister Guido Mantega and others, foreign policy makers accused the Fed of engaging in currency wars, deliberately weakening the dollar to gain an advantage in trade. Second complaint, raised prominently by Reserve Bank of India Governor Raghuram Rajan among others, was that shifts in Fed policy, toward either greater tightness or greater ease, were creating spillovers, sharp swings in capital flows and increased market volatility, that destabilized financial markets in emerging market countries. Such beggar-thy-neighbor policies became very contentious during the Great Depression, where depreciation was a zero-sum game, so that gains by one nation, came at the expense of other nations. The current situation, and what investors need to know. Hopefully, we are near the end of Federal Reserve's crippling of foreign markets. There is some hope seen in the recent firming of commodity prices. Currencies have stabilized somewhat. And, foreign markets have bounced off their lows. So, are things getting better? Foreign policy makers and their people can only hope. Unfortunately, there are those in the US that believe rising debt is not a problem. And they don't believe the consortium of 70 countries that want to end the US currency monopoly has any power to do so. Have emerging markets turned the corner? For the first time in 5 years, a few analysts are getting bullish on emerging markets. This change of heart is based on 1, cheap evaluations, and 2, foreign exchange competitiveness. Note that weaker currencies make their exports more desirable. However, foreign economies are likely to show a high degree of variability due to different sensitivities to commodity prices, geopolitical tensions, and the Fed's interest rate policy. Also, some foreign markets will experience difficulty in making needed structural changes, dealing with lower commodity prices, tax revenue shortfalls, central bank credibility, and build-up of imbalances. Thus, those with a myopic view, who don't make the necessary fiscal structural changes, will continue to experience difficulties. Consequently, the worldwide recovery will be uneven. So, investors must be selective. While other economies are already benefiting from lower current account deficits and improved fiscal balances due to the savings from lower oil prices. And, as a result, they are seeing greater underlying support for their currencies. So, as an investor, if you can look beyond short-term market volatility and emerging market dispersions, emerging markets should interest you. The key assumptions here are that most emerging market risk is already priced in, some tailwind is abating, and lastly, emerging markets should continue to deliver higher growth rates than advanced economies. The upcoming credit crisis in the U.S. According to Harry Dent, the U.S. economy is in very dangerous territory. More dangerous than anything we've seen since the Great Depression. We are sitting on the precipice of the greatest global financial crisis in history, and this time, no amount of Fed stimulus will be able to contain it. This negativity of the U.S. market going forward is echoed by others, such as George Soros, Alan Greenspan, Carl Icahn, Stanley Druckenmiller, and many others.